Dear friends, wish you a very wealthy and healthy 2019. 2018, the year gone by, was the toughest in terms of making money. Beginning of the year was marked by high optimism, reflected in valuations which were above historical average by a margin. Rising oil prices, depreciating rupee, rising interest rate, default by AAA rated entity like ILFS, tight liquidity, and FII selling resulted into crash in small and mid-cap stocks and correction in large-cap stocks. However, among all the gloom, corporate profitability kept on steadily improving. When everything was looking lost, suddenly oil prices corrected against all expectations. They have remained subdued for a reasonable time. Drop in oil prices brought stability in rupee, and actually rupee started appreciating. It also rekindled FII investors' interest. Open market operations done by the RBI improved liquidity condition from extreme negative to slight negative. Drop in Indian inflation and US Fed's unexpected turnaround on the future course of Fed rate hike pulled Indian interest rates down by almost 75 basis points. Appointment of professionals to run ILFS along with timely action by the government and RBI to contain NBFC liquidity squeeze has helped economy regain its growth momentum. Indian economy is at an interesting stage. Last few years, structural reforms like GST implementation, demonetization, insolvency laws, transparent auctioning of public resources, digitization, formalization of economy through expansion of tax base, etc. has created short-term pain in terms of disruption and higher compliance cost. The long-term benefits of the same are accruing in the years to come in 2019 and beyond. Indian economy also went through a transition where the RBI was transitioned from being an all-rounder to a specialist. Before 2016, the RBI was managing with remarkable success conflicting objectives like rupee, growth, interest rates, inflation, and banking sector stability. We ignored the adage, don't repair what ain't broken. We adopted Western world standard of inflation targeting and mandated the RBI to manage inflation and growth. In the early days, to establish the credibility as inflation hawk and bring down the double-digit inflation, the RBI controlled quantity of liquidity as well as price of liquidity. Real interest rates remained high and banking liquidity remained tight to bring down double-digit inflation within the mandated range. While the RBI was extremely successful in bringing down the inflation, the inflationary expectation still remained higher. High inflationary expectation pushed RBI to pursue tighter monetary policy. This put a speed breaker on growth as quantity of liquidity and price of liquidity remained non-supportive. Around same time, the RBI started cleaning the banking system from the menace of non-performing loans, which was long overdue. In absence of adequate capital, cleaning up took its toll on transmission of credit, depriving sectors like real estate, infrastructure, construction, and NBFC of vital credit flow. 2018 was the year where Indian economy ran with a handbrake on. But we believe that credit events of 2018 were one-off incidences, and spread assets with their risk-reward trade-off offer an attractive investment opportunity in 2019. As the liquidity eases, the same will be reflected in the spread of good credits, be it AAA or otherwise. With crude and inflation remaining stable, the RBI MPC is unlikely to hike interest rates in the near future. In fact, a situation is emerging which may lead to market discounting rate cuts. We expect credit risk funds and duration funds, which are overweight on corporate bonds, to outperform in 2019. There is an exciting opportunity in front of India through US-China tariff war. In the 80s, India and China were of similar size. China became manufacturer to the world. We missed that bus. Today, China is more than 6 times bigger than India. Due to tariff war, many companies are moving out of China. If India can attract those manufacturers, our exports can take a quantum jump and we can expand manufacturing base to create inclusive and faster growth. Indian economy can move to double-digit growth in years to come due to the structural reforms undertaken in the past. It will obviously require supportive liquidity, smoother transmission of credit, and reasonable real interest rates. With the RBI on top of inflation, this should be possible. It also requires capturing supply chain disruption unleashed by the US-China tariff war that will help expand our manufacturing base. Indian economy looks well poised for 2019 and beyond due to low inflation, fairly valued rupee, under control fiscal and current account deficit, and improving banking liquidity. Obviously, oil price movement will continue to play a crucial role in impacting Indian economy. Market movement tracks corporate profitability trend. Better liquidity, lower real interest rates, fair value currency, smoother credit flow, and improving capacity utilization will support higher corporate profitability growth in 2019. Indian economy, which was running on consumption engine between 2013 to 2018, will get a boost from investment side in 2019. With the correction in 2018, equity valuations have become fair. Small and mid caps look little better valued than large caps. Domestic flows showed little bit of slowdown in 2018 over 2017. Hopefully, they will be maintained at the same level in 2019, which will support the market. FII flows turned negative in 2018. It's difficult to take a call on the FII flows in 2019 as there are conflicting factors. Our weight in MSCI Emerging Market Index could be reduced, adversely impacting flows. India has outperformed other emerging markets by a big margin. Our valuation is at a historically high premium to other emerging markets because of that outperformance. India will be the fastest growing major economy in the world in 2019. All these factors will have influence on FII flows, and let's hope and pray that FII flows remain positive in 2019, unlike in 2018. In the past 2 decades, election results have created material impact on market on the day of results. Over the course of the remaining period, elections don't make material impact. The general elections result will impact market on the result day. Market today is pricing in a stable government which will pursue the path of higher economic growth. From an opportunity point of view, 2018 was an English or Australian cricket pitch where making run was difficult. 2019 could well turn out to be like an Indian cricket pitch where making runs might be easier. However, the basic technique of making runs will remain the same. 2019 looks promising for making money compared to 2018. The basic tenet of long-term investment and disciplined investment through asset allocation will hold good for investors. Wish you all a very healthy and wealthy 2019.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.